Hi, welcome to a live event from Prime Investor. My name is Srikanth. I am a co-founder of PrimeInvestor.in. And today with me I have Deepak Shenoy, a market expert, a prolific writer, and recently an author with his own book, Money Wise. Without much ado, Deepak Shenoy doesn't need too much introduction to this audience. So without much ado, let me just welcome Deepak. Hello, Deepak.
Hi,
How are you doing?
all good. How are you? Thanks for having me in your show, Shrikant.
Absolutely. This is a very nascent show, so let's not make it look like David Letterman or anything like that. So it's a very beginning, humble show. So let's see how it goes. Thanks a lot for agreeing to be here.
Are fantastic. Always glad to see to be here and to talk to you, of course, and larger audience here, I guess. But audience of one is also good.
Excellent. So congratulations again on your new book. I have been following your writings for I don't know, seems like forever, a decade and a half, I would think. And you've been writing, quite a bit in your blog and in various forums and essays and things like that. Just calling it a blog probably belittles a little bit, but I just call it like financial essays. Why a book now? Why not earlier? And why now? What spurred you to get going with writing a book at this time?
Shrikant, the earliest I think talked about writing a book was in the blog in when it was only a blog in 2007 or 2011 or something like that. It was more than 10 years ago that I thought that writing a book would be interesting. But two things. First of all, the format of a book has a different way to the whole, the structure to the whole thing. It's a very staticish kind of concept where the writing that I have to do sometimes is more dynamic in nature. Stuff that the timeless parts of writing is where a book would be useful because then you can keep the book for a while and then kind of read it over a time. But two things. I mean, the second part of it was also the fact that I had no time. So there was a business to
Uh,
run and a lot of other things, and so things never worked out. And suddenly, with COVID, the ability to have some time, bring it together. A publisher from Juggernaut, Chiki from Juggernaut, contacted me and said, we'd this would be interesting to pursue, and I have to give it, to credit to her that she pushed me to kind of get this thing done, even though so many things were happening all at the same time. I was doing an MBA. There were two businesses to run, but we had a lot of content on Capital Mind itself. So taking parts of it from different places, rearranging it was my job. Really, it took some time to get things done, but. The interesting thing about it is it's a physical book. So as I grow older, I find it more difficult to read purely online. So a physical book is actually quite interesting. I could have perhaps published it a long time ago, but laziness and inertia. So I will blame it on myself more than anything else. But I think it's a good time to kind of come out. Though I think for the last 1 year, bookstores haven't been open, and only recently have they opened. So hopefully, people will be able to buy it off of physical bookstores as well as the online ones.
Yeah, it's very catchy. Beautifully, the cover is very attractive and, catches your eye. If it's in a bookstore, this will be the first thing that people will see. And speaking of people who will see the book, right? When you got started, then, for a person such as yourself, you are a PMS manager, you are going to be a mutual fund manager pretty soon, and you run your own, capitalmind.in with, a stock recommendation service and all that. So there are so many things that you could have covered, right? When you started off, who did you have in mind for this book as a target audience? As like somebody, this I want to write a book for this person. Who was that person?
So to be honest, the book targets people who are relatively new to the financial world. So when I say that, I specifically mean we write a lot of jargon, right? We on internet on Twitter you will see me saying something like yields have fallen to 6.25%. And then for somebody who's just coming in for the first time, they have no idea what that means. That's just out of context or I'll talk about a stock and somebody RBI is taking over some company and or a superseded a board of something. This is stuff that's useful to people who are been in the market, so fairly aware. And then there's another layer of awareness that I might add on to that. But what this book was essentially about somebody who is relatively new to the markets, does not have a framework for investing. So typically, somebody who comes into the market for the first time is overwhelmed by too much information, wants to make a lot of money in stocks in 5 days, wants to do a certain set of things. So these are evolutionary criteria. So some people say, well, you know what, I should do this and I'll start making money. Or so how does one even look at the investing process over a period of time, and what parts of it are define who you are? So it's in a way kind of a basic framework that tells you this is how you start off, and then once you get into the specifics, you can always become more advanced as a player. You can understand ROE and ROC and all those complicated things that one needs to know to buy into stocks. But I started off writing it to a more sophisticated audience, and then I said, well, the sophisticated audience already has enough.
Mm.
Uh, also the publisher was also more helpful in trying to bring that information over to
Sure.
me, and she told me that there are more people looking for information on how to start than on how to get better. So maybe there are more books in me, and I'll write for different audiences, but this one is for a primary uh, initial starting off kind of audience.
Okay. Let me tell you something. I mean, I have ordered books from Amazon since '98. This is the first book that ever that I've pre-ordered. Okay, so that I don't know if that counts for anything, but that's something there. But I finished the book on. I got it on Friday. I finished it on Saturday. The way I saw it, the book, I would phrase it like this, and please tell me if you agree or disagree. That this is for investment curious people. People who can consider themselves as they want to get in, but they're not confident enough. They don't know if they know enough to get into the thing. If they read this book, I'm pretty sure that they will get the confidence required to say that I have a pretty good understanding of what's going on in the markets. So I'm not going to get, to use your own words, suckered by the markets, and I'm going to do reasonably well. The book kind of gives you the confidence. I think. Would you agree?
I hope so, because I mean, unfortunately, coming from where I am, I cannot sometimes put myself in the shoes of a beginner person reading the book, because it's been so long since I've been a beginner. So I try to dumb it down and also make it interesting. So the language is a little more informal and peppered with a little bit of humor here and there. The
Definitely.
idea being that it's very boring, otherwise finance is boring. So you had to keep it exciting enough for people to say, well, I want to read, because there are things in there that may be more than just finance, but also at the same time try to give you enough knowledge to be able to feel confident about investing. I think the main thing that I try to bring across in this book, at least, is that it is not simple, but it's not so complex either. There are approaches that are simple, there are approaches that are complex. And if I were to do a fair job of explaining the landscape to you, I'd have to tell you there's the simplest path, there's a more complicated path, and then you find the way that you might want to do to get there. So I think different people will probably read this in different ways. Some of them may just look at it and say, I want this is too complex for me. I just want the simplest way to do things. And the other person might say, listen, this is interesting. It's intrigued me. It's given me enough room to say I'll learn more, and then the more can come from the internet and sites like Prime Investor and perhaps Capital Mind also. And so there's more information that they can absorb and learn more.
Absolutely. There was one. There were many, funny lines in the book. There was one that really made me LOL, laugh out loud. That's the one where a person is trying to sell you some insurance, and your toddler does not have the same appreciation of your, sense of time or something like that. It was positioning your child with an insurance agent that just made me crack up while I was reading it. Anyways, yeah, some funny stuff there in the book too. So let me make an observation. I have been in this, field of, counseling people for advice for a few years now. My perception is that, investors in India have a very, binary view of the concept of risk. They either want to go, all fixed deposit savings bank account, all guarantee kind of conservative. If they want to take even a little bit of risk, they want exorbitant amount of returns for that little bit of risk that they are taking. So they are like either on one end or the other. Have you seen such a behavior, and how do you talk to such people and say that you need to take a middle path and have a more balanced approach when it comes to risk adjusted returns?
This is an interesting question, Srikanth. We actually, since we run a PMS also, we come across people. There are people at that extreme end of the spectrum, low, extremely zero risk and extremely high risk. But now we've noticed, and as we've grown the PMS, we've kind of seen this happen across in front of our eyes. Is people are actually coming and telling us, Deepak, forget the last 1 year, because the last 1 year is not going to be replicated again for a long time. We don't expect 50% returns every. So they are
Good.
coming and telling us, and we are almost a little embarrassed sometimes because everybody in this market has made 50% at least in the last 1 year.
Correct.
So it's difficult to. So we are actually going to customers and saying, listen, guys, we'll have a problem going forward, but this is still a better way to be than to just take your money off and put it into a fixed deposit, because over time markets will still give you great returns. But the interesting thing is that customers are more or less, aware of it. So a lot of them have been through phases in the past when markets did nothing or markets were deeply negative, and they're not. And so the thing that they understand is that we balance them out between equity and debt, so that the cushion for a fall is, there is some cushion for a fall. This is not true, however, of a lot of newer players in the market. People who have newly started in the market uh, tend to have a higher expectation of returns and or a very low. So their idea of risk is like this: if the market goes up, they want the up, but if the market goes down, they don't want the down. There
Exactly.
is a large amount of population, and the problem is you can never tell someone how it is to feel this way. That is
Mm.
to actually say that, listen, there is a lot of risk. That means you will lose money. And when the markets are going up, people are saying, "Huh, I have the appetite to lose money." And when they actually lose money because the market falls, when I say lose money, it's just that portfolio value has come down. It is then that they get very disappointed and suddenly realize they don't have the appetite for the same kind of risk. It is that time that there's a lot of disappointment. The people walk away, they get angry, they get unhappy, and so on. This misguided expectation thing is not just India; it's worldwide. No matter when you look at it, the note by, I think, one of those, I think, famous guys, I forget, Jeremy Grantham. There's a
Mm.
podcast by him where he
Mm.
actually said in 1998 they predicted that there would be a downfall, the end of 98. So through 1999, they were low on equity. They kept very conservative equity numbers. They saw the market go up 53% in 1999. Uh, and they didn't make any of that 53% because they were
Mm.
out of stocks. So their customers were angry and they left. They walked away from them. They lost a considerable amount of AUM, and afterwards they were actually proved right because the market collapsed in 2000, and then in the next 3 years they increased their AUM 4 times because there were more people who came in. But he said, of those people who left us when they were unhappy about having had not been able to participate in the upside, none of those people came back because
Yeah.
they left me angry and disappointed. And that difference of expectation caused
Yeah.
new people to come in. They said, "Oh, Jeremy is, they've been in bonds all along when the market's been falling. So we would like that kind of security." So it's a different set of public that comes in when risk actually hits you, when there's a different set of people who will participate when markets are only going up. So I think this is one of those phases when markets have gone up. People
Mm.
have extreme risk. They say they have a high risk appetite, but they actually want a higher return for
Mhm.
every. risk that they take. This will correct itself, and it will correct itself usually badly. So you identify who which people will sustain based on whoever survives the downturn. So
Yeah.
we'll recover that very soon. However, one thing I would say here is you don't necessarily have to bring them back in. You give them the middle path. There will be some people who will figure it out and some people who will never figure it out. There are some people who are just natural gamblers by because they gamble a very small percentage of their capital. You have net worth of 1 crore and you put 1.5 or 2 lakhs in equity, and then it goes up 20%. You feel very excited that it's gone up 20%, but that 20% doesn't do anything for you. So if you
Exactly.
have 1.5 lakhs or 20,000, 30,000 rupees out of a portfolio of 1 crore, which is nothing, but you feel really good. So they gamble away that little tiny amounts, and then when they lose a lot of money, they say, "Oh, you know what? Stocks are rigged, and equity markets are rigged, so we won't go there." So that public, I don't think is going to be. I mean, they're going to be very vocal. So you'll hear of a lot of them on Twitter and on, a lot of websites. But I don't think they are the bulk of people who make capital today. Also, retail individuals own more capital, more shares in terms of market value in the market compared to all the mutual funds put together.
Mm.
So even today, so I'm talking non-promoter. Promoters are different.
Yeah,
They
yeah,
are in the market, but even among the non-promoter stake, retail investors own more than all mutual funds put together. So we're a relatively nascent economy in that sense. So I think the maturity will come. The low interest rates now, relatively low inflation. Even if you count tomatoes, which was up 3 days ago, and now it's down. So even regarding that, you'll see that I think the maturity will come in, and perhaps people's expectations will also, come down
sure.
over time.
Yeah, I mean, segueing that, I mean, going to the stocks chapter. I mean, different people might find value in different parts of this book. I found Paisa Vasool kind of a maximum value in the chapter on stocks. I mean, you're a fantastic storyteller, Deepak. You've always been, and that really comes through shining in the chapter on stocks. Thanks for that. So, for a investor, given all this that you just spoke about, how should they uh, consider or think about allocating, is like 1% of a 1 crore portfolio in stocks? I mean, that's not the right approach, right? I mean, what is the right approach they should take when they think about direct equity investing in terms of portfolio allocation?
So this is interesting because it's very difficult. So the word, so mutual funds, you don't hear people telling you anytime, I'm not going to invest in this mutual fund because it's at a high. So if NAV of a mutual fund is 25 rupees versus 30 rupees, there's nobody coming and telling you, no, it's a 30, man, it's never been at 30 before, let me not invest in this. So they do this SIP mode, and there's a lot of disciplined investing that happens in mutual funds. So if you're that kind of an investor, I think that is where you should be, and you should say, listen, I don't have this expertise to select stocks or track them, or do all the other things that mutual fund managers do. So let me just give this away to a mutual fund or an index fund and let them handle it. Now, if you want to go direct stocks, you are now going to deal with differential knowledge. In the sense, you'll have some knowledge, the market will have much more knowledge than you, and you'll be a little surprised about how much the market knows more than you. So, in a way, you have to start building a philosophy around what works for you. So, for some people, it is a pure technical characteristic. So, it doesn't matter what I'm buying something that is going up.
Mm.
This would be a more technical approach where you're saying, I look at the prices, I look at the volumes, and the prices and the volumes will determine trends that I will use to select stocks, and I will exit also when the trends don't sustain or
Mm.
momentum is lost in the market. This is a pure price based approach. Then there's a
Mm.
pure fundamentals based approach where you might go and say, I'll look at the company's books and I'll try and understand what they're doing, see where there's scope for growth and see where there's scope for value. So some companies I might buy because I think there's value in them, that I'm buying 1 rupee at 50 paisa in the market. In another case, I might say I'm paying 1 rupee 50 paisa for a company, but then it will be worth 3 rupees later. So I'm banking on the future to give me a much higher growth potential. So this is more fundamental driven investing, where you're saying, I like the business and I like the business for different reasons. And those reasons come together to a point where I buy the stocks. And then you might do a combination. So I'll buy good companies, but only when the trend is in my favor. You kind of combine the two. These are evolutionary paths. So people usually start off somewhere, and then they start off with usually randomness. Friend told me, let's buy, this
Exactly.
motors company, and then they go buy it. And after a while, if they find themselves analyzing their own stocks and investments, they might actually say, well, you know what, this is not the right approach. Let me go slightly deeper. So you go to start to look at websites and books that tell you about fundamentals. They go down the fundamentals route, find that the fundamentals don't often correspond to actual underlying company reality. So what the books tell you and what the company actually does or sometimes says it does is a different thing. You might say, oh, great growth, this is a fantastic company, it does this, it'll make steel, it'll keep on increasing the steel production. Then you find that when the steel prices go up, their production is higher. When the steel prices go down, they don't produce, they don't make profits, they keep going through these 6 year, 7 year cycles. And you're like, that's not a company I want to be with for the longest term in my life. Why should I be with a company that cannot evolve out of something as boring as steel? And then you
Mm,
go down the rabbit hole of saying, I like the fundamentals, but there's more to fundamental, more to stock movements than fundamentals. So they can find great stocks which are value traps. Um, they are There are other problems with stocks which are not evident in the books. Sometimes it's that the promoter is over leveraged. You have no idea why should make a difference, but suddenly the company starts performing badly when the promoter is over leveraged. That's because the promoter is trying to take money out of whatever he can, and sometimes it's the public listed company that makes bad decisions because he's in an over leveraged state. These are not things you learn in books, because this is like more practical street knowledge. So when you combine all of these elements over time, your realization finds you about what makes you happy in the direct investing market. So you may find yourself happy with being a pure fundamental investor. So somebody tomorrow tells you that there is this new startup stock that went up 500%. It doesn't affect you in the least because you're like, no, I like certain types of companies and I will only buy this new startup thing, not my piece of cake. I need at least a 5 year operating history, profitability, good ROE, good ROC, versus somebody else who might say, listen, I like only startups. I like startups because they make new businesses work. So if you go, the idea of the stocks chapter was to introduce you to all of these types. And
mm,
one of the guys I know that did it really, really well was there was this book called How I Made $2 Million in the Stock Market by, I forget the name, but he was a dancer, an artist, and he built. I think there was this Darvas, Nicholas Darvas. Yes, Nicholas
mm.
Darvas. In fact, he invented a technique of technical analysis called Darvas boxes. While he was charting stuff, without software, just drawing things by hand and figuring out when stocks were breaking out into a new zone and breaking down from up to down. And he built this over time. So he started off with taking tips from brokers, didn't work. Started off fundamental analysis, didn't work for him. He started his technical thing, but he wasn't sure. He didn't like any of the standardized techniques, built his own technique, and then wrote a book about it. Of course, he made $2 million in the stock market. And this was, I don't know, 1930s or 40s or something like that.
Wow.
So, so this was a pretty interesting book, and I got the thought process from there saying, why don't I make it a story instead of telling people, oh, you can do also this, you can do. So I said, this is how I evolved. So I built out the story out of there, and I think the thing about stock markets is, in the end, you have to discover who you are,
Correct.
what makes you happy. I'm not an intraday trader. I have done it before. I've tried it, but I don't like it. So
Okay. Okay.
I'm not that. But there are some people who are very happy being that. So if that makes you rock, then that's it. But uh, the idea is find your mojo. Don't depend on someone else's mojo. Even you're directly investing in stocks.
Exactly. I mean, when I was reading the chapter, that aspect, what you were talking about, find your own style, here are some options, and here are the things that you could try in terms of how to go about finding your own style. I mean, that was a lot of. I mean, I found that very insightful and very valuable. And I hope people read the book and people think about that. I mean, it's not an easy process. It doesn't happen to you in short time, but over a period of time, when you do that and you stick to that, that's where there's a lot of money and there's a lot of value that you can build in your portfolio. I think. I mean, that comes through very clearly in the book. Um, Joseph Alexander, there's a question, a YouTube
Wow,
question.
cool.
Um, what does a good long-term aggressive allocation of portfolio net assets should ideally be? Um, Go ahead,
I will
Deepak.
say
Go
one
ahead.
idea.
I don't exactly know what he means, but go ahead and take it.
Yeah, the problem here is the word ideal.
Yeah,
Ideal for whom? It's like, somebody told me this collective good of society, but the collective good means who? Does it mean you? Does it mean your next door neighbor, a shop down the road? What is the ideal allocation for somebody for? So I think there are some heuristics you can use. And I won't say AI ML because it's an often misused term. You should not use these
yeah,
things in this context at all. But there are heuristics rules that you can use. So, for instance, if you have a lot of debt, that means you've taken a loan, right? So you can't be overexposed to equity markets. You're going to have to deal with the fact that at some point your job, maybe in a public company, that goes bust because it's not able to raise capital because the capital markets are down. If all your money is also in the stock market, then your job is gone and your money is gone. So why would you? And then you have debt. So you have a problem in allocation. So if you're someone who has a lot of debt, then you should not have these extreme equity measures. So I won't give you formulas like 220 minus your age or whatever that is, 100 minus your age is
100.
equity. This does not apply actually in a lot of cases. I'll give you an example. If a person is 60 years old, has more than enough money to take care of personal expenses, has no dependents, why should you tell him that he should be only 30% or 40% equity? He can be 80% equity because he may have so much money that 20% that is in debt is more than enough to take care of his needs for the next 30, 40 years. So there is no formula that applies to every person. And sorry, okay, sorry. The issue is when you try to do idealized asset allocation, it applies to some people but not to all. And some people have shorter term goals. So if you have shorter term goals, you necessarily have to have a higher debt-ish component. If you
Mhm.
have longer term goals, then depending on the kind of those goals. So for instance, I'm saving in the PMS, we have this goal oriented framework. So we can actually say, oh, I want to save for my son's education. So please track the path of it over the next. I want to build it such that we have something like 20, 25 lakhs a year, which is the cost of higher education nowadays. Just build inflation into it and try to target it. I've given an example in the book as well. So I just keep investing over there, and then the adjustment over there is just how much debt and equity is there in those goals, which adjusts itself over time. So in the PMS we have it, but there are mutual funds also do the same thing. So 35% equity or 65% equity, 35% debt. You can do something like that where you say for a certain goal, I need a certain debt and equity combination. For another goal, I will have a higher equity combination because it's much longer term in the future. I may not know what I want to do with it right now, and I don't know what time frame. So, for instance, I'm saving. I know that my kids' education comes in these years. It's a very fixed goal. Whereas if I look at how much time I have for something else, which is say, I want to take a holiday and go all over the world at some point. So that will take me 1 month or 2 months. But I don't know whether this will happen 5 years down the line, 15 years down the line, 10 years. I don't know when. So there I might have a different allocation to debt and equity. And I say, listen, I'll just go for it. Whenever it becomes this great amount, I'll take it out and start doing this thing for me. And once you have these little metrics or goals in place, stuff that you really want to do, that's what you want to save the money for. Because all money has to be saved for spending. If you're saving to give it to your next generation, then you're making the cardinal mistake that I think we shouldn't make. Because money is only built for spending. It is not built for being saved or invested. In the end, it has to be spent. So if you spend your life saving and investing, then your next generation will spend all that money. Let them earn their own money. You give them the education. So
Absolutely.
you might as well
Absolutely.
do your thing with your money. So if you plan to spend it in a certain way, the idea should be just find the asset allocation that goes. Worst case, there's this saying by, I think it was a great guy, great saying. It was in, I think, psychology also. Um, when the guy who invented this CAPM, or I think the asset allocation formula, I forget which one it was, Markowitz. He had built this fantastic thing about how you can allocate between debt and equity using certain percentages, this, that, class, asset class, geography, all sorts of things. And then somebody asked him, "How do you invest?" And he said, "I don't have time for all of this. I put 50% of my money in bonds, 50% in stocks, and we're done."
That's it. End of story.
If you don't want to do all this drama that I'm talking about, just put half your money in stocks, half your money in bonds, you're done. Something will do well
Exactly. Exactly.
over time. So I mean, I can make it as complicated as you want, and as simple and as simplest as this: 50%
Exactly.
in
I mean,
bonds.
it depends on how much money the advisor wants to make, I guess, in terms of how you
Fortunately,
want
that is
to answer the
the
question.
no, I
Let
don't
me
think, man. To be honest, advisors have a tough time because you have to explain. People don't like inactivity.
that is
So
true. There's an action bias always.
yeah, so in effect, people have to act just for to be. You have to bleed just to know you're alive, right? So you, it's that kind of feeling, saying you can't deal with inertia. I mean, the lack of some kind of movement. So every year, somebody has to suggest something.
Exactly.
Um,
Exactly.
uh,
Otherwise, you don't feel like you're earning your keep, right?
and nobody will pay you. Um,
Exactly, exactly. So the next question I'm going to take, and I'm not going to embarrass you with this question, but since both Capital Mind and Prime Minister are working in similar area of retail investor education, it would be interesting to hear Deepak and Srikanth review each other's platforms. Let me just stop with saying that Deepak has one of the best personal finance content recommendation platform, especially when it comes to stocks and PMS in the country, bar none. So I'll just leave it at that and move on to the next question.
I love Prime
Moving on to the
Minister.
next question. Moving on to the next question, Deepak. Madhavan Sridharan, I don't really understand this question, but let me just put it up there. On a scale of 1 to 10, 1 being ignorant, how does a needle move for a financial illiterate move towards do your own? I
To
think,
do it yourself. Yes,
yeah, do
yes.
it yourself. I think you have to be at least a 7 or 8 to be a do it yourself investor. Um, you have to understand the math, you have to understand instruments, you have to understand the variety of instruments, you have to understand market, you have to understand. I mean, do it yourself. What do you think, Deepak? I mean, is DIY? I mean, there's a big DIY movement. How do you, what are your thoughts? Bit
No,
of a putting
DIY
it
is
up.
not
Yeah,
necessarily bad.
yeah,
It's a very good concept. But here's the my deal, okay? Everybody will go through this path. They will
sure.
start off with one, being financially ignorant. They will reach a level they call eight. Because
Take on it.
when you make money, you know everything.
Yeah.
Then they will go back to two. Because when there's a downturn, you suddenly realize you don't know anything. And then in the end, you'll reach about five, which is where I am.
Oh,
Because
please, you're into
anybody
humble.
who's no, it's true because honestly,
Even if you are at 5, a lot of people are in trouble. I can tell you that.
no,
Okay.
a lot of people think they're at eight. That's just fine because at
Yeah.
some point, even I knew everything, right?
Sure.
I'll give you an example. There's this story about a little girl, and she was drawing something, and the teacher asked her, "What are you drawing?" She said, "God." He
Mm.
says, so she says, the teacher says, well, nobody is seeing God, so nobody knows what good God looks like. The girl, without looking up from her drawing, she says, now they will.
Mm.
Because when you're young, you're confident, you do not say, listen, I cannot know this because other people, if everybody knew this, then this couldn't be true. So that youthful innocence is actually very useful. It helps you build things. Tesla, for instance, is that the guy questioned the entire concept of an internal combustion engine being the driver of transportation. And today, look, we have come to a point where electric vehicles are phenomenal, and you have to have that questioning attitude right from the beginning. But um, whether that makes you a great investor or not is about a point when sometimes in the middle you'll find that you discover that you don't know enough of anything. You may know a lot about something, but it still won't be enough, and you will
Mm.
never know enough to be able to tell. And I think Maddie is probably super experienced, and he knows he's asked this question, and he knows enough about certain types of investing that I would simply not even be I would be his student about,
Mm.
and there will be things that I know that he can learn from me. So there's never a point when you're not a student. You'll be a student and you'll be a teacher.
Absolutely. That
Yeah.
is true.
So given this,
So
I think the path is like this: you go from one end to the back, and then you find your
and then
pendulum
you
somewhere in the
settle
middle,
down.
and then you'll always die not knowing enough.
It's a pretty dark spin on it, Deepak. But we'll go with that. We'll go with that. So let me, in the interest of time, let me get some quick hitters. Um, there's a question about in the context of the impending listing of LIC. How do you see the life insurance sector playing out? LIC seems to be ceding market share to private players. Do you think LIC will ever be dethroned or at least be on par?
It is some 86% of the insurance market. No, I don't know what dethrone means only, because all these 25 years that these private players have come, they have taken like 15% market share. Uh,
Put together.
I mean, really,
They are the
how
behemoth and
can
they will be
they
the
be
behemoth.
exploited? Yeah, I mean, the point about this is they are the only guys who have so much data about India that almost
Mm,
all of these other insurance companies use LIC's actuarial tables to run
mm.
their business. And you have to say that also LIC is one of the it's not a pushover. It may be a public sector entity, but it has an
Definitely not. It's a gorilla.
extremely
It's a
strong
500, 600, 800 pound gorilla, whatever.
yeah, I mean, and really, this is an agile gorilla. They'll
Oh
put
my God. Yeah.
new products in. They will put so whether other company maybe the idea should be, if you're participating in a company, it's not like one guy will cede market share to the other. It's the whole market has to grow. And I think the market is relatively small today, underpenetrated. We're hoping that at some point it will get highly penetrated, but the problem lies in companies like LIC and all the other insurance companies also. They make lousy products and they sell them through trust. So your
Mm.
friendly neighborhood LIC agent is usually a good person. So you trust them, and the
Most
problem is that
times. Yeah.
yeah, most in the sense they're good in the sense they're selling you a product that. So it's like this. Sometimes the worst investment product can still be better than no investment product, no investment at all.
That
So
is
a
true.
person who never does any investment for him, but then are we all like that? Uh, we are all smarter than that. The minute you get smarter, this product is not for you. So
Mm.
if LIC were to go beyond this concept of uh, investment product and really lousy investment products bundled into what
Insurance.
are what are insurance policies. I
Mm.
think there's a lot more scope here, and we can get to much bigger and brighter days. Even today, for instance, if you buy a pension policy, you have to go to an LIC office personally to prove you're alive every year.
Mhm.
So I'm like, why would I do this? Why would I even buy a product that requires me to do this? But then every insurance company has similar processes. So how are they going to take market share away from LIC if you're doing the same things that LIC is doing?
Mm.
So so that way, I think space is interesting, but practices need to change and the market needs to grow. I don't think you should bet on private insurance company because it will take share from LIC. LIC is not going to just stand aside and let you take that market share.
Exactly. That. Here's a question about from somebody who has read the book. You mentioned in your book, I think we spoke about it, but if you want to, add a point or two, know who you are, how to know that, whether you are technical or fundamental investor or value momentum investor, how do you find your risk appetite? That's a great question. I go ahead.
I'll give you this one thing, okay? And Shrikant, you're also a parent, so I guess you'd know the thing. When you didn't have a child, if somebody gave you gyan about how it is to change diapers, not sleep at night, and all that stuff, all that was gyan. It came in, but it never really registered. And
Absolutely.
then when you had a baby, and I'm talking about us guys, okay, for women, it's like a whole different ball game, right? You're you have no idea what it is to do it until you actually do it. That means until you actually had a child, you can't actually tell people I know what it is to have children. And men will never ever in their entire lives be able to tell what a pregnancy is like or a delivery is like, because we have no context at all. And we can, of course, we can never be that. You can at best have, like, I don't know, a kidney stone, but apparently it's worse than that. So
Okay.
the point about this is, unlike the women in delivery thing, you can actually experience investing. So you have to try all these things to figure out who you are. And sometimes you have to lose money because that's part of the
That's part of the
game.
game.
Yes. But you have to discover who you are not by reading, but by doing. And
Mm.
I wish there was a formula that said, if I told you these things, it would happen. What happens, I can't tell you how your gut lining will react when the market falls and falls more and falls some more. And unless you were in 2008 when you could have felt it, or last year for a very brief period of time, if you were in the market in about March and April, early April of 2020, you could actually feel that gut wrenching, you know, fall. Market recovered very fast. We're
Mhm.
lucky. 2000, it took 3 years for the market to recover, and um, the market fell some 75-80%. In 2008, it fell 60%. This time, it fell only 40. So, uh, you unless you actually go through those emotions, you don't find out who you really are. And sometimes this period can take 6 years to discover. Sometimes it takes you 6 months saying, "I have found it. I have found what I want to be."
Mm.
But it's okay to be wrong about that. You can say, "I found what I want to be," and you do something, and then you find out that's not what you want to be. You find out you're something else. This is part of a human discovery process. There's no formula for it. But what I would say is you have to keep an open mind, keep exploring, because that's
And
the
keep
way
things
you.
interesting. Yeah.
I mean, you could be a crypto investor.
Oh, hey, now don't take me there because I'm going there myself. Because there is a question about currency and stuff like that. I mean, the way I see it, I mean, they're talking about regulations for crypto and things like that. I think whatever the government does, they're going to make a bunch of people mad and a bunch of people happy. So I think the government is in a kind of a no win or no lose, whichever way you want to see it, situation right now. What is your take on this? I mean, what do you think the government should be doing in this situation or should have done probably
In the cryptocurrency world, it's quite. I mean, I think in the end they'll probably call it an asset and leave it at that.
and be done with it?
The problem with this is it's a very difficult situation. I mean, they keep telling you, oh, all these blockchain transactions are on the blockchain, so you can figure out who has sold to whom. But it's not true, because if you buy in an exchange, the exchange intra exchange transactions, so I buy from you in an exchange, they are not stored on any blockchain. The
Correct.
problem with that then becomes you can launder money easily. You can do all sorts of things. The government will probably put in another layer of restrictions around what constitutes this crypto madness as a crypto assets, if you may. But
Hmm.
I don't think they'll be easily allowed to use it as a currency, which literally means that you might see, for instance, that an exchange in India would have to deduct TDS before uh, you kind of buy and sell assets. It could happen. I'm not saying that it will happen, but if that happens, then it'll let us say cut down the lure of crypto a lot more. I think crypto should be regulated, should not be allowed to be a speculative asset of this crazy magnitude. That there should be penalties for people who do fraudulent things with crypto, to the extent that they should be taken to jail, and and we should do this in the stock markets also. No doubt about it. But at least there's something happening over there. Here, there's nothing happening, not addressed by the ecosystem at all. And of course, I also think crypto should, if it is ever used as a currency, that means as a mode of payment, um, it will be finished all over the world. The minute you start using it as a payment in any meaningful form, not only the governments act against it, but the very people who own it will act against it.
Mm.
It's a very philosophical thing, but you don't want your assets used as currency. If it's used as a currency, then you start becoming poorer in that asset every month because the asset increases in value. So everything else decreases in value compared to this. And you don't only own that asset, you own everything else. So effectively, you try to hoard the asset and not sell it, which is
Mm.
what's called hodl in crypto. They keep holding the asset instead of
Yeah.
selling it and doing it, and that becomes a problem, and it's a currency. And if it becomes a currency, it will be a problem. So I don't think it should ever become a currency. I also think from an asset perspective, there needs to be heavy enough regulation that penalizes fraud and reduces this extreme speculatory influences on it as well.
Yeah, the one thing is, I am not very confident that the government is capable of such nuance in terms of its regulation. I think it's going to be they're going to try to treat it like a Gordian knot and, swing the axe at it or something like that. We'll see.
Yeah,
We'll see in a couple of days. I think we'll have an idea of what they will
there'll be a bill soon. I don't think they'll write it off and say make it zero. But
do.
if America does it, India will be able to do it. India will not do it unless one of the major economies does it. So
Correct. Correct. So there's a question, a quick hitter again. Apparently this person knows something about your opinions on gold. Why don't you have a favorable view on gold? Speaking of alternate hedge, inflation hedge assets and things like that for long-term investments. What are you comfortable with? Come on, Deepak.
I have zero money in gold. I try to sell my gold. Yeah? I mean, to be honest, in April this year, we
Sure,
said
man.
let's try and sell our gold. We went to jewelers. They said no, we can't. They got psyched. They said, "Why are you selling your gold?" I said, "Look, I don't like gold. I want to sell it." They're like, "No, no, you can take other gold in exchange." I said, "No, no, I don't want other. I want money. So give me money, and I'll pay tax on it. No problem. Just tell me you pay me by check, and I'm fine. Just give me the money that you want." And even though I was willing to take a 10% hit, they gave
Wow.
me like, "Oh, this ornaments could be stolen." I said, "What stolen? It's like small pieces of ornaments that we've had for like I don't know how many years. It's got my name written on it. How can it be stolen?" "No, no, no. We want proof of authenticity and all that." Excuses to make you feel that
Seriously.
you shouldn't be selling it. What point is this? This is not a savior of whatever it is and all that stuff. It doesn't do anything to
Exactly.
anybody really. It to me, here's the thing: you bought gold because you didn't trust the government, largely. And today, I think we have no choice but to trust the government. And if you don't trust the government, we have bigger problems in life because if the government goes down, every part of our financial life will fail. Whether it is an SGB, SGB is just a government-backed thing linked to gold. That we've gotten lucky over the last 3 or 4 years. Not even that is very specific 3 or 4 years. If you bought 3 or 4 years ago and you get out now, you'll have made I don't know maybe 5 or 6%. Um, uh, but if you look at from 2000 to now, gold has returned very little in comparison with the overall market. Has underperformed literally all asset classes which are productive, like equity or even bonds. Bonds have done better than gold in the last 20 years in India, 18 years in India. And if you look at the gold since the crisis to now, we've had a crisis. So the crisis, the gold shot up. It went to $2,000, right? Now it's at $1,780 in dollar terms. Dollar is
Mm.
also roughly the same, 75, 75 then, 75 now. So if in the period of the worst crisis in the world, the gold hasn't gone up and the stock market's gone up, what, 50, 75, 100%,
Mhm.
then really is gold what you should be buying to hedge against a crisis because it'll go up in a crisis perhaps, but then it'll not do anything after that. Today, the gold prices will go down another 10% simply if
Mm.
the government reduces the duty on it. There's a
Wow.
10% extra duty in India on gold, and then
Mhm.
there's a 3% excise duty. They reduced the duty from 12% to 10%. That brought down gold from 55,000 for 10 grams to 45,000 for 10 grams. Now
Wow.
it's about 840. Now it's about 46. or something. If they were to reduce another 2%, I can guarantee you it will fall to 42. That's because India is the second largest consumer of gold in the world. And
Mhm.
if India sees the price falling, people stop buying. If people stop buying, the world demand comes down, and therefore the gold prices come down, and that causes another spiral. And then all India has to do is reduce the cost of gold by 2% every quarter for the every year for the next 4 or 5 years, and gold as an investment product will no longer be valuable. The government did that once, and we've seen the impact. The government will do it again, I'm sure, because gold imports are fairly large chunk. Now, of course, last quarter was not very good, but it has been a large chunk of our imports. Net of gold, I wrote a post about it today. Net of
Mhm.
gold, India has been positive on the current
Mhm.
account last 6 quarters. So that means we are a net exporter if you don't consider gold imports, because gold is largely an asset, right? It's not considered a consumption good. It's an asset. You buy it to hold it for value or whatever it is. It's similar to your buying a house in America.
Mhm.
If you buy a house in America, it isn't considered that you've consumed the house. So it's not a trade deficit. Whereas gold is given a special term, it's part of the trade deficit. So if you remove gold, we are a net exporter. And
Wow.
if you just take that very simple fact and say, ki, let us reduce the allure of gold and make everything else more attractive, not by increasing the duty on gold, by actually reducing the duty on gold. Because in
Mhm.
assets, if you increase the duty on an asset, the asset goes up and that makes it more attractive. So you have to reduce the duty in order for it to become less attractive. And over time, that will actually cause a much. So that is one of the reasons why I find gold is a very boring metal. If you're losing faith in our governments, it's of no use, because if there's absolute anarchy, you need guns. If there is less than anarchy, very high inflation, which again I don't think is possible. Very high inflation in our environment of these high money printing and high productivity driven growth. I don't think inflation is going to be a problem for the next 5 or 10 years.
Sure.
But I could be wrong, but I don't particularly like gold at all.
Got it. So, the last, there are a couple of questions on index investing.
Cool.
And one person has asked if there is a strategy to beat index funds consistently. Another person is saying that index investing is getting a lot of traction. So, on the whole, your thoughts on the whole active versus passive. Can you beat index? Just stick to index, or you have a nuanced opinion about this active versus passive? I think we'll wrap up with that question. I think we would have covered all the questions from viewers. Thanks a lot, everyone, for the questions. But your thoughts on active versus passive, Deepak?
So active versus passive is this. Okay, so active investing, if you don't really have the time to analyze so many fund managers and their returns, and then if you buy 5 or 6 funds, they may be the same stocks in multiple funds. You don't know which one is going what, and maybe I'm buying 5 large cap funds, and all of the funds have the same 80 stocks that they have to buy. They're all buying them in different proportions. So net, I have the same portfolio. I'm just paying three different managers. Instead of that, you might as well buy an index fund and pay less to one manager, which will be an overall much bigger saving over the long term. You'll kind of get there. This is actually a very good, useful philosophy. So I use this. I have a portion of my portfolio allocated to passive, which is a passive strategy within our PMS. Also, we run it with Capital Mind. Also, we encourage it, which is basically two-third India's top 100 stocks and one-third US Nasdaq top 100 stocks. This
Mm.
combination seems to have done really well in the last 5 or 10 years since we have data for it, and
Mm.
I think it will do very well going forward. The last 1 year has not been so great, but if you look at 2 year or 3 years, this portfolio has outperformed nearly all of the active large cap funds. Now, why
Mm.
would you choose active is if it does two things. First, it protects you from the downside. That means if the market falls, it gives you
Mm.
some layer of protection. Um, we have a portfolio called Momentum, which actually went into cash last year. So that gave a layer of protection on the downside, and it has outperformed on the upside. But the combination of the two what something that I feel more comfortable with as a strategy that might potentially or not beat the index, but at least gives me less heartburn in terms of portfolio performance. The second set of reasons why you want to outperform the index is because sometimes the index chooses a certain set of stocks. These are typically large cap stocks. They are the most biggest stocks. There's no edge in them. The edge is in smaller stocks. The edge is in mid cap or small cap stocks. So if you find portfolio managers who specialize in those, then or mix them up with the larger caps, then you have a potential chance of beating the index itself with higher risk. That means I should be now ready for if the market falls 20%, I'll fall 40. But when it goes up, I'll go up 40 or 50. So the combination of these two tends to be useful for a portion of the portfolio. So I'd say one portion in large caps, which is index, one portion in mid and small caps, which is active, another portion in something else, which is momentum, which is more, gives me a different push on the upside. And that this is the kind of strategic reasons why I would choose active versus passive. Over time, India will also reach a point where even the mid cap funds will not have an edge over the mid cap index, and that at that point is when I will go for the mid cap index. I don't think it will happen in small caps in India. It hasn't even happened in the US. I think US small cap indexes don't tend to beat the
Those
mid cap
possible.
index, just as a this thing.
Mm.
But and then you can have custom indexing. You can buy an index that is a combination of other indexes. So I could like we have a combination of India top 100 plus US. You could build yourself the kind of index fund you want. For instance, you could say I want to choose um, India plus US plus emerging markets plus some debt plus some gold, and that becomes my little custom portfolio, which consists of various indexes all over the place. It's a simple enough portfolio, but I mean you should do this. So some for some people who don't have the time to think about active and small cap and mid cap and all that, just indexing works. It's perfectly fine. If
Mm.
somebody wants to do some more detail and say, I want to go into small and mid cap, some of it direct, some of it through mutual funds, and then the rest through strategies like an index, strategies like momentum, strategies like low volatility, or any of these different strategies that exist, you can then combine index with them. So I think index investing is a very, very powerful thing for a very large number of people. That means if I went to a person who does not know anything about finance, I would be much more comfortable telling them about index funds than it is to tell them that buy this
Definitely,
particular mutual fund.
definitely. So thanks a lot, Deepak. The book is money wise. It's a must read. It's a fast read, and it's a very interesting read, and it's a very valuable read. Deepak, thanks a lot for writing the book, and thanks a lot for coming on the show and sharing your thoughts and answering very patiently questions and stuff like that. Thanks a lot, man, Deepak, and the very best wishes with your book. It's going to be a big hit. I mean, you don't need luck for that. You've already done the hard work, and hard work trumps luck all the time. But whatever luck you need, you're going to have it. So, best wishes, and thanks again for being here. Thank you.
Thanks, Srikanth, and I'm waiting for your book, and I'll be on the other side of the interview when you do it. So I
We'll
look
see. We'll see about that.
no, but
Thank
all
you.
the best. It was really
Thank
nice
you.
to be here and really lovely listening to
Absolutely.
your voice and get the questions.
Absolutely. Thank you. Thanks.
Cheers. Thanks.